Financial ratios are created with the use of numerical values taken from financial statements to gain meaningful information about a company. The numbers found in a company's financial statements, balance sheets, income statement, and cash flow statements are used to perform quantitative analysis and assess a company's liquidity, leverage, growth, margins, profitability, rates of return, valuation, etc. The leverage financial ratios measure the amount of capital that comes from debt. There are four common leverage ratios. The first one is the debt ratio. It measures the relative amount of a company's assets that are provided from debt. This means that the debt ratio equals to the total liabilities divided the total assets. The second one is the debt to equity ratio. It calculates the weight of total debt and financial liabilities against shareholders' equity. This means that the debt to equity ratio equals to the total liabilities divided the shareholders' equity. The interest and coverage ratio is the third one. It determines how easily a company can pay its interest expenses. This means that the interest coverage ratio equals to the operating income divided the interest expenses. And the fourth one is the debt service coverage ratio. It determines how easily a company can pay its debts obligation. This means that the debt service coverage ratio equals to the operating income divided the total debt service. The liquidity ratios are financial ratios that measures a company's ability to repay both short and long-term obligations. The common liquidity ratios include the following. The first one is the current ratio. It measures a company's ability to pay off short-term liabilities with current assets, which means that the current ratio is equal to the current assets divided the current liabilities. The asset test is the number 2. It measures the company's ability to pay off short-term liabilities with quick assets. The asset test ratio is equal to the current assets minus the inventories, all divided by the current liabilities. If the answer is above 1, it can cover with its short-term obligation. If it's below 1, it cannot. But if it's 3 or above, it means that the company is being inefficient in handling their money because they have a lot of money that it's not generating profits. Efficiency ratios are also known as activity financial ratios. These ones are used to measure how well a company is using its assets and resources. The assets turnover ratio measures a company's ability to generate sales from assets. The assets turnover ratio equals to the net sales divided the total assets. The inventory turnover ratio measures how many times a company's inventory is sold and replaced over a given period. The inventory turnover ratio equals the cost of goods sold divided the average inventory. The accounts receivable turnover ratio measures how many times a company can turn receivables into cash over a given period. Receivables turnover ratio equals the net credit sales divided the average account receivable. The days sales and inventory ratio measures the average number of days that a company holds onto its inventory before selling it to its customers. This means that the day sales in the inventory ratio equals to 360 days divided the inventory turnover ratio. It's not 365 because technically there's 5 days in the year that are considered holidays, which means they don't